Hello and welcome to the quarterly webinar for Landmark Real Estate Management.
Mhm.
Welcome, everyone. Hi, Kim. How are you?
Good. Good morning.
How you have just been through the third quarter of the year,
Yes.
and in the third quarter of the year, there is a lot happening at Landmark. Tell us how things are going.
Yeah. So we've just kind of ramped or completed our pre-leasing season. So now we're kind of getting into just the end of the year. So budgets, winterizing, property inspections. It's kind of the calm before the next storm when it all starts again at the beginning of next year.
Right. Wow. Right. Yeah. Busy season. A lot of units turned, a lot of movement in the rental market, a lot of changes
Yeah.
at the state and local level. We're going to hear all about that later from Kim. So, if you're just joining us, thanks for joining us. Again, we do this at Landmark every quarter where we come to you and talk to you about the national and then the local market, and then also trends that are affecting you as real estate owners, multifamily owners here in Whatcom County and beyond. So, thanks for joining us. This is being recorded, and so you'll be able to watch this. Kim's going to hop off now, and we're going to hop into we'll see her in a little bit, and she'll join us later and talk to us more about some of the landmark stats. But again, if you have questions, feel free to put them into the chat. And we will discuss those questions with you at the end of the webinar. But thanks again for joining us. We're going to go ahead and get started here now. So again, just want to talk to you a little bit about what we're going to be doing today. We are going to review the national multifamily market. And we're going to look at the local market in Bellingham and Whatcom County. And then we're also going to look at factors that are affecting the market moving forward. So, um, once again, want to introduce myself. I am Troy Moliot. I am the owner and CEO of Landmark Real Estate. On behalf of all 55 employees here at Landmark, thank you. Thank you for your business. Thanks for being a part of Landmark and entrusting us with your assets, with your properties. From single family homes up to large complexes. We appreciate you and we appreciate your business. Want to talk to you just a little bit for some of you that are joining us that maybe don't know about Landmark. We want to talk to you about our core purpose, why we exist here at Landmark. And we like to say that we open doors and build wealth. We help clients do that. We help clients open doors to new properties. We open doors for tenants every single day here at Landmark. And then through that, we want to help you build your real estate wealth by preserving those assets and taking care of them and optimizing their values. We have three uniques that make us different than our competitors. We're trusted. We are structured. We have a lot of structure in place here at Landmark, and we're adding new structure. And we are also investor focused. Our core values, and we've got five of them here, and all of our employees know these. These are hanging on the walls at Landmark, and we hope that you, as our clients, also would share in these core values. We like to do what's right. We maintain accountability. We're problem solvers. We drive change, and then we love to serve others first. So again, thank you for sharing that little bit of time with us to look at some of those things with Landmark. We have a proven process when a new person comes online here or we talk to owners. We like to optimize or analyze, improve the property. We manage property. And we'll talk about the management model on the next slide. We deliver results. We solutions and results, and then we grow. We help you look for opportunities and then also build your wealth and your real estate wealth. This is our management model, and this is what we do every single day here at Landmark. We market properties, we qualify, we onboard, we collect rent, we collect a lot of rent. We maintain the properties, we communicate with you on a regular basis. And then when properties or tenants transition, we work through that. So Once again, that is kind of who we are at Landmark. Thank you for listening to that. And for those of you that are new to Landmark, feel free to reach out to Kim or I, and our information will be at the end of this slide. I'm going to go through an executive summary, and I always do this in our quarterly webinars. So for those of you that don't have a lot of time, I'm going to hit the highlights of what we're going to be reviewing. We'll take about another hour to go through all of the slides and all the information. I look at a lot of data on a regular basis, on a quarterly basis. And so I try to bring you bits and pieces of what I'm looking at. And hopefully that helps you learn a little bit more about the market and understand where the market is changing and shifting. So, our executive market for the national US market, and I said this last quarter, and I'm saying it again, it's time to buy. And I believe that the time is now, and that the things are positioning for investors to start looking at adding to their commercial assets, specifically multifamily. Bonus depreciation is back. The tax changes that are in place now allow for 100% bonus depreciation. Need to talk to your CPA about that, but that was tailing off here the last couple of years, and it's back in place. And so I think depreciation and offsetting people's income is something that's going to drive investors to looking to buy more. And I'll talk to you why about sales activity is important. I'm going to show you some slides on that a little bit later. New construction, again, is falling. It peaked back in 23, and so new construction is falling off, and that's helping allow a lot of that supply that's increased vacancy rates, helping that supply come down. And as we absorb market or more people rent units and fill those units up, vacancy rates start to come. So construction falling is a positive thing for the market and for future rent growth. Vacancy rates are really at 10-year highs nationwide. They still are. We're stable. We didn't uptick this year, but we're not downticking yet. So we're stable and we're peaking as we speak. Existing rents are flat to really slightly increasing with some new product that's coming online. Sales have decreased about 60 to 65%. They're up slightly in the Q3 versus Q4, but not much. They're pretty close to flat. So, but still down overall from the highs that we had back in 21 and 22. Also, continuing on with our executive summary for the national market, interest rates. There's really a lot of pressure to go lower, and I've got a few slides on that and what the experts are thinking. Cap rates appear to have topped, and so we're starting to see them fall a bit. And again, as the cap rates come down, that is good for values. Price per unit, the value per unit is actually starting to increase again. So again, we're starting to see the market change and turn. We were predicting this, and now we're seeing it take place, and it's starting to happen. And I think we're poised for, I think, a different transitional year in 2026. So excited for the U.S. market. Let's look at this summary for the local Bellingham and Whatcom County market. New construction, when we look at new construction locally, that again drove up vacancy rates to over 10-year highs here locally. And, you know, we're seeing new construction currently this year and into next year really slowing significantly. It's been harder to pencil deals when I talk with clients about building new buildings because of today's rates and construction costs. It's harder to make a deal pencil. And so that's why we haven't seen a lot of new construction. People are on the sidelines, ready to build, but waiting for costs to come down and rates to come down. Vacancy rates have peaked. They fell this past quarter, and you're going to see that in the stats. So again, that's exciting. And for the first time, we're under 6% in almost 2 years. So you'll see that information here shortly. The overall rent per square foot is again increasing slightly again. It was flat and it's starting to increase just a bit. And we're again, our rent per square foot is higher than the national average. So that's strong. Sales, Again, been really fairly flat. We had a big spike in the second quarter of this year. There was a one large sale, and so it's really kind of tweaked things a little bit. But again, that sale is significant. So one big sale that kind of skewed the market locally. The multifamily market here again, cap rates are leveling out. And then new regulations at both the state and local level, they've been changing this past year. Kim's going to talk more about those in the middle of our webinar. But there's been significant changes that have affected you as an owner and then also how we manage properties. Okay, so that's our exec summary. We're going to hop now in to the actual data, and I'll take you through for the next around 45 to 50 minutes, all the information on the national market and the local market, and then some other factors. So let's hop into that data here. So the nationwide vacancy rate, I've been tracking this for years now, and I always like to kind of throw this out. Here's where we're currently at. In January of 2023, when we started these webinars, we were at 6.3%, and that was rising at the time. And a year later, we were at 7.6%. A year after that, we were at 8%. That's the beginning of this year. Mid-July, we peaked right around 8.2%. And basically, as of just yesterday, we're still at 8.2%. So we're flat. We're not green yet, but we're not red. So we are flat at 8.2%. We're holding and predicted to start to fall in the next couple of quarters. Here is that on a graph. And again, this data is coming to you from CoStar. That's where I pull a lot of the data that you're seeing. And this data is for 5-unit complexes or higher. So houses, single-family homes, duplexes, triplexes, and fourplexes are not in this data set. Just want to clarify that. So this is, a survey. It's not the survey, but this gives you a pretty good idea of where the market's at. And you can see right here that, we're right around 8.2% and falling. Now, as you can see, the orange line, that is the overall vacancy. The overall vacancy takes into account properties that are in lease up, new properties that have been built that are still in lease up, and maybe they're half leased up or 25% leased up. This is the overall vacancy. The blue line is the stabilized vacancy. When we just look at stabilized properties, not new construction, we're right around 6.5%. So that's what people should be experiencing in the US. You can see it's predicted to kind of move up just under 7% and kind of flatline for the next 2-3 years. So again, don't think that we're going to see vacancy rates below 6% in the nation anytime in the next 5 years. At least CoStar is not predicting them. This is just, again, an overview. When we look at the last 12 months, I bring this to you every quarter. So we're always just kind of pulling the next 3 months and looking at the last 12 months of units delivered. We're down again. We've delivered in the last 12 months 560,000 units, new apartment units on the market. We have absorbed about 501,000 of those. That number is down from the previous quarter. The vacancy rate is flat, right around 8.2%. Typically, when our absorption and our units delivered are about the same, then vacancy stays the same. When absorption goes up or down, then vacancy rates go up or down. And the monthly asking rent growth is actually under 1%, and it fell. It was 1% last quarter, and now we're down to 0.6%, and we're falling. So rents are falling nationwide, and they're starting to decline recently. But when we look at the last 12 months, we're up only about 0.6% over the previous 12 months. Here is rent per square foot. So when you take all the units, studios, ones, twos, threes, fours, you look at every single unit type, and you look at how many square feet they have, and you look at what their rent is on a monthly basis. This is that line. And I like this line because I think it just cuts through everything else. It's nice to look at specific data, but This rent per square foot is something that I look at. And here we are. We're right around $1.95 to $2. We've been that way for about 2 years in that range. And we're below the trend line. That trend line back from 2019 at $1.65 to where we're currently at. Again, we're falling below that trend line, kind of moving sideways to slightly up. This is data basically from CoStar that just shows you every single year how many, new units came online, and, what the average rent is and that vacancy. And so it just kind of gives you a nice idea of the vacancy, what the market rent is. Here's where we're currently at nationwide. We're at $1.97. And then you can see kind of projections that we're projected in 2026 to break $2 a square foot. So that's what CoStar is showing. And then by 2029, be at $2.20 a foot. Hence why I'm saying it's the time to buy, because I think you're going to see rents start to move up about 10% over the next 4 to 5 years. So again, not a lot, but it's still significant. So that just gives you an idea kind of where we've been and where we're going and what those average rents are. And I think that's a good number to kind of look at. This shows you multifamily starts. Again, this is kind of a trailing 12 months, and you can just see that, what happened in 2020, 2021, 2022, with very cheap debt, with a lot of dollars being pumped into the system from the COVID situation. It was a perfect storm for a lot of construction to happen, and we overbuilt. We overbuilt significantly multifamily, and that has been falling off since the middle end of 2022 to currently. So we're really at historic, really 50-year lows on construction. So we're really falling dramatically. And again, that's a positive thing for the overbuilding that occurred in the multifamily sector. This just shows you by quarter. So every orange bar is essentially a 3 month period of time, how much we have had in construction. And you can see the peak delivery of units. Those units started in 2022, 23, and they were delivered in 2024. And those units, we were delivering almost 200,000 units per quarter. It's a lot of units being delivered. And in spring of 2024, that was really the peak. And we've been falling off ever since dramatically. And you can see that construction is projected over the next 3, 4 years to be well below where we have been the last 5 years. So again, could be, again, another factor that I'm seeing that's positive from a supply and demand standpoint for investors to look at buying stabilized assets. This data comes to us from apartment lists, and this is again another. This has all bedrooms and all units, so this factors in single-family homes, duplexes, triplexes, and fourplexes as well. So all data, and again, their rent per square foot, and you can kind of see just where they're at on their rent line, and you can see the trend there. I think the big thing is to look at what happened with rents in 2021 to 2023, where rents really spiked dramatically during the COVID. The money that came into the system, people were wanting to rent their own units. The demand for new units was strong. People were building units. It's a perfect storm. And rents really dramatically increased. And that affected housing costs dramatically. And you can see really for the last 3 years, we have been moving sideways to slightly down. So again, this rental data from apartmentslists.com. This shows you the year-over-year growth from apartments lists, and you can just see that really what happened is growth. We were seeing dramatic rent growth in 2021 through 2022, where we were growing close to almost 10% a year, up to over 15% at the peak. And then we've fallen back down, and we have been below 1% growth really below 0% growth since the third, fourth quarter of 2023. So really dramatic changes here in the last 2.5 years on rent growth. This shows you every month what that the last bar is doing, so you can kind of see where we're at. And really the most recent bar, we're down in another 0.4 of rent. We tend to be seasonal or cyclical, and so you see a lot of times in the spring rents move up. It's a positive time for people to rent, and it's a popular time. And then that's typically when we see more rent changes. And then in the fall, things tend to fall off. And so that's been the historical change trend. It's been a little bit more dramatic in the past few years. And you can see that we're starting to fall off here in the fall as people kind of miss that spring, summer lease up period. And now we are, we're falling back off and predicted to fall really for the next 3 or 4 months on the U.S. rental increases. So that's where we're at there. This is the vacancy index by apartments list. It just kind of gives you an idea of where we're at. And again, they're showing us just above 7% on all properties. And this is their overall vacancy rate. This is an interesting chart. I've been bringing this to you the last couple of webinars that we've done. And this just shows you the median time to get an apartment leased, the marketing time. And you can see the trend here that's been occurring where we hit a low. We were averaging pre-COVID 25 to 35 days. That was it, right around 30 days to get a unit leased in the nation. And then we fell to under 20 days during COVID. People were gobbling up units. And we have been working our way back to that, I would say, more historical norm. So right now we're at 31.3 days time to market and lease a unit and get it rented. And so again, but it's been moving up. We'll continue to track this and bring this data to you. I think it's popular, but it's just taken longer to rent units than it was 3, 4 years ago. This just shows you another graph that just shows you that apartment rent is kind of stalling, and so we're really down the last 4 or 5 months. This data is only through the middle of the year, but this data is continuing to drop as I look at other sources for this. And so it's just, again, we saw the market moving up, and then it's been pulling back here recently. So again, and this includes all concessions, which we're seeing a fair amount of properties in the U.S. offering concessions now. Okay, key stats. Let's just take a quick pause here and go through a few different stats. Q2 of 2024 was the top for multifamily construction with new units that were added. New permits construction is slowing, and we've really slowed 4 quarters in a row now. The absorption of new units is strong and continuing to increase despite the inventory, and we're coming back into balance. I predict that really into 2026, we're going to see more units being rented than are being built, and that'll be positive, and that will push vacancy rates lower. Due to the supply, the time to lease is really at a 5-year high, and we're coming back to what I would call that pre-COVID norm. Rents are starting to increase slightly, again, overall, but just barely. Month to month, we're down, but year over year, we're up just slightly. Let's look at some sale data nationwide. And again, just trying to spot some trends here and look. The orange bars show you volume by quarter. And this goes back to 2020, actually the first quarter of 2019. And you can kind of see the volume that we had. The volume is on the right side in billions of dollars. The blue line shows you the price per unit. So take how many units you have times that, and that's the US average. The numbers locally here are higher than this, but again, this is the US average. And so you can see that we've really been building up. We bottomed back in 2024, and we're starting to move back up. above $230,000 per unit and increasing and projected to increase even more. So you can kind of see that peak spring of 2022 value high, and you can see the volume at the time in that last quarter of 2021 where we had almost 120 billion in sales in one quarter, whereas our average is right around 40 billion. So again, just some big quarters in 2021 and 2022, and sales volume increased the price per unit as well. More volume. I'm going to show you some additional stats on that later as well too. You can see that the low is in. We hit a low on sales volume back in the first quarter of 2024, and we have been kind of moving above that. We're still down quarter over quarter when we look at the third quarter of 25 to 24. We're basically neutral to slightly up. Whereas from that low, we're still up, but we're down dramatically, still 65% from the highs that we had in the 2021 and 2022 years. This just again, just the same graph, just trying to point out that over the next 3, 4 years, we are projected to see values per unit increase. CoStar is predicting that, and we concur with that, that we believe that we're going to see values start to move up. Hence, again, another reason why I believe it's time to buy. Key stats in the multifamily market nationwide. Values peaked in the spring of 2022. Values have pulled back and appear to be stable and now increasing. The supply of new units, new construction is slowing and continuing to slow and will continue to slow. And that's good for the market. With reduced new construction, values will continue to increase and ultimately set new highs in 2027, probably 2028 for sure. It's the time to buy. So again, we're calling that. We've been calling that now for a couple of quarters, and we believe that, yeah, 2025 and 2026 are the time to buy. Some other key stats on the U.S. market is that transaction volume is flat, really from the previous, quarter and the previous year, Q3 of 24 to Q3 of 2025 in the last 12 months. Sales are down 60% from the peak in 2022. Again, sales volume really drives prices. And so I want to just kind of drive that point home today. I think that's really important. So as you see volume increase, that's a healthy thing for your value, whether you're selling or not. Let's talk a little bit about capitalization rates. Let's talk about cap rates. I want to talk briefly about this because I want to show you some cap rate data. And so, a cap rate, what is a cap rate? And I've talked to you about this the last couple of quarters. A cap rate is really an indicator between your net operating income, your NOI, and the sales price or the price that the value of the property. And so your NOI is really that net income that you would receive after you collect all your rents, you factor in a vacancy, you pay all your expenses, including your management fee. Thank you. But it does not include your debt service. So it's before debt service. That's your NOI. So that's that number that the appraisers are valuing when they're valuing it. The bank's looking at that. That is a key indicator that you want to look at when you're buying or selling a property. And so dividing that into a cap rate gets you the value. So it's also your annual rate of return if you paid cash for a property. So, if we put so much money down and we wanted a certain return, that's really what we're able to pay for the property. And so here's a couple of, I always say we have to buy high. You want to buy at a high cap rate and you want to sell at a low cap rate. So the lower the cap rate, the lower return someone's willing to take and the higher price they're willing to pay for that asset. So there's an inverse relationship. Let me give you a couple of examples on cap rate here. If we had $100,000 of net income, net operating income, and again, that's what we can take for after we pay all our bills, before we pay our mortgage, if we have one, before we take any draws. That's our net income before we pay tax. And if we needed a 6% return on that property, we could pay, or the property would be worth just about a million six, million six fifty, million six 66 to be exact. And so that's what it would be. At a 7% cap rate, we could only pay about a million four and a quarter for that property. So again, we need a higher return. And again, we're just taking 7%, dividing that into the $100,000. And that gives us the million four. If we take 7% or 0.07 times a million four 28, we get $100,000. That's what our net income would be. Net income's kind of fixed. Whatever our net income is for the year is what we're going to collect. And by capping that or applying a cap rate or a percentage, that gives us the value of the property. So if we have the value and a cap rate, we can get the net income. If we have the net income and the value, we can get a cap rate. We can back it. If we have two, we can solve for the third. So again, this is just appraisal theory, valuation theory. This is how most investors are looking at properties based on a cap rate. This is how your bank is looking at how to qualify the property. I have a calculator. If you go to crecalculator.com, I actually teach all of this online for free. So feel free to go to this website, learn more about property values, cap rates, put in all your information. If you have any questions, feel free to reach out to me. There's a button on there where you can click and even send me your valuation, and happy to look at it. But this is just a tool that I've built for you, for investors, to be able to value your property and understand the relationship between cap rate and value. So here are the US cap rates. And so we hit a low cap rate back in spring of 2022. So remember, we saw on that previous screen where we saw the high value, high price per unit back in the spring, the cap rate was at its lowest. And so again, correlation there where we were under a 4.4% cap rate. Today, depending on the star rating of the property, we're between 5.5% and 6.25% nationwide. Okay, let's go through the summary here of the U.S. market, the nationwide U.S. market. Construction boomed and peaked in 2024. Rents are flat to slightly increasing with new product that coming online. Vacancy rates are peaking and really have peaked, and they're stable now at that 8.2% level. Sales are increasing slightly. And then loan to values have really decreased, from what we saw in 2021, 2020, 2021, 2022, where we had, 78% loan to values with 3.5% interest rates to 55 to 60% loan to values at the 6.5 to 7.5% rates. Today, I'm seeing most debt in the 6 to 6.5%. We haven't broke 6% yet. We're getting close. Again, everything kind of depends on the asset that you have and the amount of equity that you have in the property and its location, whether it's a core asset or more of a secondary asset. Cap rates are starting to top out. They're very interest rate driven, that is for sure. And then the price per unit is falling and has bottomed and starting to move back up again, as we showed you in that previous graph. Whew, okay, that's the U.S. market. We're going to hop into the local multifamily market, and then we're going to get into some landmark stats. So the Bellingham multifamily vacancy rate per CoStar for 5 units and up, back in January, the beginning of the year when we started this, we were at 2.4%. Man, that seems like forever ago. A year later, we were at 6.6%, jumping up dramatically. In January of 2025, a year later, we were down a little bit to 6.1%. Mid-year, we were back up to about 6.5%. And then today we finally broke 5%. We're 6% and we're at 5.8%. So we've coming back down again. So we've been topping here the last year and we're finally under 6% and heading back down, but they're still high. They're still historically high. We're a far cry from the 1% and 2% that we saw before 2023. Here is the graph again that shows you, again, the orange bar is the overall vacancy, and then the blue bar is the stabilized vacancy. So we peaked at well over 8% earlier in 2024. We've been falling, been a little bit volatile here lately. And then our stabilized vacancy is right around just above 5%, 5.2%. So that's where we're currently at. Again, this is 5 units and up, not totally inclusive, but I would say a very solid indicator to vacancy rate right now in our market. The amount of units we've delivered in the last 12 months in the Whatcom County, Bellingham area, 123 units. So that's been falling. So this is looking at the last 12 months. So that number's been falling dramatically. The amount of units has actually been falling as well, but it's still much higher at 313 units than the units delivered. So as we absorb more units, as we rent more units, the vacancy rate is dropping. So you can see that significant drop down to 5.8%. And then that 12-month asking rent growth is actually up this quarter over the last 12 months at 2.7%. So again, 1 year over another, up just under 3% year over year. And that's what people should be seeing. Nationwide, that number is only 0.6%. So nationwide, pretty flat, whereas Bellingham, a little bit healthier. Here are those kind of key stats and indicators that show you the breakdown of all the units. So you can kind of see the vacancy between 1, 2, 3, 4, or 5-star properties. Not a lot of difference. The lowest vacancy is in those high-end 4 and 5-star properties. They're getting the most attention, and their vacancy rate is 5%. There's a lot on this graph, sorry. A lot on this graph, but this shows you, again, absorption, which are the orange bars, how many units are renting by quarter. The blue bar is new properties being built and delivered in the market. So again, those two pieces of information really, really will move the vacancy rate. And then you see that the yellow line is the US vacancy rate, and the green line is the Bellingham vacancy rate. So a lot on here, but I love this graph because I think it tells a really great story. The Bellingham vacancy rate is below the US vacancy rate. And then you can kind of see what's happening as far as absorption predictions. So again, we're not scheduled to deliver a lot of units in the next couple of quarters. There's a big project that's 350 units in Ferndale that's scheduled to be delivered sometime mid-year of 2026, and that's going to skew a bit of the market. There's a few other buildings in there that are also going to be delivered that CoStar doesn't have. So again, there's a new project down in Old Town that Dawson's building that's 84 units. There's a couple other smaller buildings and such. So those aren't calculated in here as well. So again, I might see a little bit more volatility. And again, that the new construction, the net deliveries also drives the absorption, the amount of units that will be available. So good information here. I love this graph. It's busy. This is the rent per square foot over all units, as we showed in the nationwide market. $1.50 to $2 is the range for the US. Locally, we are tracking between 220, 225 a square foot. So pretty healthy. And we've been moving up steadily since 2019. Again, not as much volatility as you saw nationwide. Let's talk about sale data in the local market. So 9 sales in the last 12 months. And you can see that really driven by one large sale of $50 million. That's the Kerf property that sold on Samish Way. And that's kind of skewed a bit of the market. But again, you can kind of see some of the sale data, what's happened. Nice to see some sales when here are those actual projects that sold and the price per units that they sold at and the price per square foot. So it just gives you kind of an idea of what we're seeing in the market. Not a lot of sales, but a few. There's that Kerf building at again $50 million. That's it's sold just at the beginning of third quarter, at the end of the second quarter. July 3rd is when it closed. This is the graph that shows you again the sales volume. Those are the blue bars, or I'm sorry, the orange bars. And again, you see the big record bar in the third quarter of 2025. That's the Kerf sale. And so over $50 million of sales in that quarter. That's a big record. One big sale that's skewing the market a bit. That surpassed our 2021 and 22 sales that we had. But again, volume, relatively speaking, when you take that sale out, pretty low, pretty low. You can see the green price per unit and then the Bellingham price per units again on the line. So you can see that they're both projected to start to move up. This is the cap rates for Bellingham, and you can see the US cap rate at the top. That's the yellow one. And then you see the green bar, or the green line, which is the Bellingham average cap rate. And, right around 5.6% is where we're at. I'm telling people 5.5 to 6% is kind of a range of what we're seeing for sales, but this is CoStar's projections. You see that low back in the mid 4% range. We had some crazy sales down sub 5%. And again, interest rate driven. There's the US caps, there's the Bellingham cap rates. Okay, we're gonna bring Kim back in. Kim, that's a lot of info. A lot of info,
Yeah.
sales and information. We're gonna talk about some landmark data now. What do you got for us? Where's the vacancy
Okay.
rate? Where's the vacancy rate landmark wise? How do we compare?
Yeah, I mean, in comparison, we're doing great, but it is a big change from what we talked about last quarter. So last quarter, if you remember, we're at 1.6. So we've jumped up quite a bit. We're currently at 3.8. Keep in mind, this does include, or let's see, this does include our properties that are in lease up. So this does include, we have a couple new construction projects that we're also leasing up. But it's a significant change from where we were last quarter. And then if we take out the properties from lease up, if you go to the next slide, we are at 3.2% vacancy. And last quarter we were at 1.4. So again, we're seeing a lot more of our clients are spending money on marketing dollars. We're pushing out to third-party sites, you're seeing some more rent concessions right now. So we've been in a very, very great market to be a landlord with under 1% vacancy rates for a long time, and we are seeing those rates start to tick up. So it's definitely a conversation that we're having with a lot of our owners right now. So for the quarter average, last quarter we were at 1.66. And so this third quarter we were at 3.87 on our average vacancy. So now let's get into some good news. Our average price per square foot is continuing to increase. So average, we increased by about 5 cents per unit type since last quarter. So you can see studios were getting on average $2.87 per square foot. And then, we've got a lot of 2 bedrooms. The average there is $2.02 a square foot. So again, those numbers have gone up by about 5 cents from last quarter. And those are just our portfolio and the averages. The next slide is a little bit more user-friendly for landlords, just to see what is the average rent per bedroom size. So on average right now, we're getting $13.39 for studios, $14.54 for 1 bedroom, $17.74 for our 2 bedrooms, $23.30 for our 3 bedrooms, and $29.75 for our 4 beds. I do have additional data if anybody is interested. We do have a handful of 5, 6, and 7, 8 bedrooms as well. I can pull that, but these are the most common sizes that we're seeing. Again, just note these are averages. We're getting less than this and more than this depending on the condition of the units, where they're located, how old they are, amenities, all that good stuff. But the good news here too is average rents by bed size, those have also increased by about 1% from last quarter when we pulled those same numbers. So that's a little bit about our internal stats. Just want to talk about what's happening in our market on the residential side. So we do have the City of Ferndale initiative that is pending. Will go out for a vote in November. We do have a handful of properties in Ferndale. It's definitely a hot market for rentals right now. So if you personally, as a landlord, live in the city of Ferndale, please, we recommend that you vote no on this initiative. It's basically a copied ordinance that passed in the city of Bellingham, which we've talked a lot about. But this does limit the amount of fees that can be charged for a tenant. And then it also eliminates a lot of fees entirely. So just to summarize, it caps application fees at lower than the cost of an application. In some cases, it limits late fees to less than the actual cost of postage required to issue the required legal notices. And it kind of has a negative impact on residential housing assistant vouchers. It discourages development of new housing. So we definitely urge you to vote no on this measure. And then City of Bellingham has another initiative that they're going to put out to vote, and that is also pending in November. So this initiative lists a variety of political activities that are already protected by existing laws. We certainly do support freedom of speech, but this measure goes beyond that, where we have some safety concerns that it might be interpreted to force landlords to allow access to secure buildings by anyone claiming to be a community organizer. So yeah, we urge residents in City of Bellingham to vote no on this. This has been an initiative led by tenant union groups, just trying to unionize tenant apartment complexes, bring in representatives that have basically the same rights and protections as the tenants. So we do have a lot of concerns with certain aspects of that initiative. So last but not least, we've talked about this as well at the state level. The Clean Building Performance Standards has passed. There are different tiers depending on the size of your building, but it does affect buildings that are over 20,000 square feet. So a single building that is over 20,000 square feet will need to be in compliance. Depending on the size of your building, compliance is between June 2026 and 2028. There are a variety of technical tasks, including some energy benchmarking, developing an energy management plan, and implementing an operation and maintenance program to meet these required metrics. We have sent out letters to all of our clients that we have determined will need to sign up for this initiation, and we've given recommendations on what vendors that we can work with and gotten some bids. We're working on getting another bid from a third party on this. We have a lot of owners also that are not going to be affected by this, but they're getting letters. So if you get a letter, please reach out to your property manager so we can help guide you through that process of either helping reach out to the state to let them know that your building is not affected because of the size, or there's multiple buildings involved. Other ways we can point you in the right direction. But we've got a lot of information on this. It's kind of a complicated new legislation, but we are happy to help navigate you through that. So that is it. That's quick, short, and sweet. Again, if anybody is interested in a free market analysis of their property, here is my email and phone number. We'd be more than happy to help with that.
Thanks, Kim. Appreciate it.
Yeah.
Good info. Appreciate it. Vacancies are up. Vacancies are up, and that's just part of the market. So appreciate you doing what you're doing. And I know the market is still shifting. So we appreciate all you're doing. Okay, well, we will continue on factors that are impacting the market and looking forward. And a lot of these are the same that you maybe have seen in the last couple of quarters. Interest rates continue to be the big story. When we look at interest rates, we look at the 10-year Treasury chart. And when I looked this morning at 9:30 Eastern time, the rate was about 4.1%. You can see this long-term trend line of the 10-year Treasury from back in the 80s when the Treasury was over 15%. Interest rates were over 18% at the time. And we've been falling for 40 years. So that trend is over and we've bounced back up. You can see that 5% line that I've got there. We have not broke 5%. And we're starting to move sideways and starting to move down. Obviously, the Federal Reserve has reduced the rates a bit this past session. More are expected to come, and so there's a lot of anticipation that rates are going to start to fall a bit. This came from CNBC, and I was just looking at the 2-year Treasury, the 5-year, the 10-year, the 30-year. So these are all different Treasury rates that trade, and this is where the market determines interest rates. The Fed doesn't. The Fed gives their indication, but the market really through bonds and treasuries that people that buy and sell those on a minute by minute basis determine where interest rates are. And they buy different terms. They buy a 2-year, a 5-year, a 10-year, a 30-year. The 10-year, that bottom left, tends to be what most people follow for commercial investment money, real estate money. But you see, all of them tell about the same story. They've peaked, they're starting to fall, and the anticipation is that they're going to start to move lower, below that long-term trend line there. So again, interesting. I thought this was fascinating. Just kind of wanted to show you that this is the expectation. We'll see more in the next quarter or two as to whether they fall below and how far they fall, if at all. This is the market expectations for where the Fed funds rate is going to be. We've had a quarter point lower raise already, and we're starting to fall. And really, by the end of 2026, by December, the expectation is that we're going to be close to 3%. So almost a full percent below where we're currently at. We'll see. We got more to come. There are 2 more quarter point lower increases baked into the market for this year, and then that would be that another 2 basis points, another 2 25 basis point increase, the decreases next year to get us down to almost 3%. So we'll see where we're at. More to tell, but this will help bring interest rates down. Thought this was really fascinating. This is a graph brought to you by Reventure. They have a great app, by the way, that you can get for free. They have a pay service as well. So I've been using this and just kind of looking at some of their data. This shows you all of the mortgage rates by percent. And so existing mortgage holders for really the last over 10 years. And the orange bar shows you people that have an interest rate of 6% or higher. And you can see back in the early 2000s, 2013 through 2020, 2021, the people that had a 6% interest rate or higher were falling. They were falling. They had almost 30% at the beginning of this, down to a low of just over 7% at the bottom of the market. And then you can see the blue line, which is people that had a 3% mortgage or lower. And so again, and then what happened is there were very few people before 2020 that had a 3% mortgage. I mean, only 4%, between 3 and 4% of the population that had a mortgage had a 3% loan or less. And so that shot up dramatically when interest rates were down where they were. And so we got up to about 25% of all mortgages had a 3% loan or lower. And so now those two are colliding because as people sell their properties, they have to get new debt. They're starting to collide and they're both approaching Those different lines are approaching about 20% and getting ready to probably cross. So where we'll see more people have 6% mortgages or higher, unless something changes in the market. So again, just thought this was fascinating. This has, big indications to the single family sale market. But again, just thought this would bring this to you. This tells the story of interest rates in the last 3 to 4 years. I asked ChatGTP. Everybody's using ChatGTP today, so I had to ask it, hey, are interest rates going to fall in 2026? And of course, it said it's impossible to predict with certainty, but the consensus is that yes, they are going to fall. So, I know AI is changing the way we do things in a dramatic way. Thought this was just kind of fun. I'm not giving this a lot of credibility necessarily, but just thought I would throw that in as a slide. Let's talk CPI and shelter inflation. This tells the story of where inflation's at. We hear a lot of inflation's falling. It was dramatically increasing 3, 4 years ago, and then it's been falling now. And so you kind of see the blue line, which is CPI less shelter housing. The green line is the housing CPI. And so you can see we really peaked in 2022, 2023, and then we've been falling ever since. And so we're just continue to track this, and we think that CPI shelter will continue to fall down as housing costs come down. With all that construction that we did, it's going to continue to bring housing costs down, which is going to help consumers. But they made a huge run, and there's a lot of pain that's still in the market from what happened, 2020 through 2023. Let's talk cap rates versus interest rates. So we talked what cap rate is. It's that rate of return if you paid cash for a property, or that indicator between your NOI and your purchase price. When we look at those two, when we look at where the interest rates are, or the 10-year treasury, that's the orange bar. And today it's 4.1%. So it's a little bit below the 4.3 that's on the chart in front of you. And you look at cap rates right around 6%, you can see the spread, the difference. And there's been times when like during the recession, the Great Recession of 2007, 2008, 2009, you saw where interest rates tanked, but cap rates also went up. They went away from each other. Typically, they tend to go in the same direction, but during volatile times, they will move against each other. But in general, they look like this. They're looking like they're in a general trend line, and the overall trend for the past 30 to 40 years is down. Even though we're still higher today than we have been, the overall trend is down. This, I think, summarizes what I was talking about earlier about the velocity or the sales activity and how they're linked to what a cap rate is. And so when you see that when volume goes up, and that is the blue line, when we see volume increase, cap rates decrease. More sales volume, more people competing to buy property, they drive prices up. And then vice versa, when sales drop, which they have been doing lately, then you see the market actually start to come back down. So again, just a different dichotomy, just a link between the two. And I think it's just really fascinating. So you see that back in the Great Recession where sales volume dropped dramatically. And then, again, that apartment cap rate actually moved up. So again, just direct correlation to volume and cap rates. So right now, cap rates or values or sales activity starting to increase. And again, we project that cap rates will start to come back down. Let's talk local inventory. This is a snapshot as of yesterday of all of the different things that are happening at the city of Bellingham level. And you can see that the amount of units are down just slightly that have been finalized in the last 6 months. Again, from 187 units that we're at 183 today. The amount of units under construction are still at 792, which again was down from the previous quarter, the first quarter of the year. And then the amount of units in application are being reviewed are actually up a bit, little bit, 343 units from 261. These numbers were 7, 8, 900 here a couple of years ago. So again, we're still down overall, but there's still some activity. You can go to this site and at any time see what projects are under construction, what the status is. It's a great resource for you. Three, let's talk about the single family sales market. I always like to bring you kind of two main charts, the median sales price chart and then inventory. So here are the sales prices. Let me just move my screen down a little bit so you can see here. And this just shows you again a 12-month rolling average of sales. The red line is the Seattle median sales price, and it has shot up another 5.5% year over year to 975, getting close to $1 million in Seattle. Whereas in Bellingham, the median sales price for the last 12 months is down almost 3%. In Whatcom County, we're down about 1%. Now that's every bar on here is essentially a 12-month rolling average. When I look at every single month, it tells a little different story. And so again, the market, you just see the volatility month by month. So again, this probably tells you a better story. If you want the play-by-play month by month, this is the chart that shows you the same stuff. And they're about the same conclusion. Seattle market's up 3%, Bellingham's down 2%, Whatcom County's down 2%. When we look at them just in the last, 3, 4 years, you really see a line that's pretty flat. We're Bellingham and Whatcom County. That's the green and the bluish line at the bottom there. We've been flat. We've been in a range for 3 years. Not a lot of change. Not a lot of change. This shows you homes for sale, so inventory, and it's starting to build again. Bellingham inventory is up, Seattle inventory is up, Whatcom County inventory is up. And when we look at inventory over really the last 20 years, including the Great Recession there in red, you can see that inventory still has a ways to go to get back up to where we were during the Great Recession. A lot of people ask me, are we coming into a recession? Is the market pulling back? Is it going to be like another Great Recession? From an inventory standpoint, we're not there yet, and we're still a far cry away from it. But inventory tells a story, and inventory locally and nationwide continues to build because mainly of buying power and interest rates. Let's talk about home sales nationwide. I used this slide last time. I kept it on here. Home sales are slow. And then this is a typical type of article that you're seeing in the media. Shows you really from 2008, that peak of 6.4 million units being sold in a year. And we're hovering right between 3.9 and 4.3 million. We're at 4 million right now, tracking, and we're just bouncing on the bottom from home sales. Not a lot of activity. This shows you the median price of existing homes. And again, we kind of go up and down, we move back and forth. But again, it's been sideways for a bit here nationwide. And you can see that we're down just slightly over where we were about 3 months ago, down to 422.6. This was an interesting chart. Again, I got this from the Reventure app, and this just shows you the average selling price. These are Lennar, they're a national home builder. Just shows you their average home price of their homes. That's the green line. And so you can see that they hit a high during the peak of the market of $511,000. And you can see how many units or orders, sales they had. And you can see at that time they had about 15,000, 16,000 home sales in a year, tracking in a 12-month period of time. Whereas today, their orders are at all-time highs, 23,000 orders, but their sales price is down to 367. It's at about a 7, 8 year low. But they're adjusting what they're building. They're building a smaller home, and they're selling more units. So again, just trends that I'm seeing in the market. Thought this was interesting. Wanted to bring it to you. Bonus depreciation. Let's talk about that. I got one slide here that really shows you what's happening. In 2018, 2019, we had bonus depreciation that came in that allowed for really significant depreciation to be put onto a property. When you bought a property, you could put between 15 and 25% of that. You could basically write that off your taxes in year one. Bonus depreciation. Talk to your CPA for the full, and it depends on, your tax situation and how you're qualified, but please seek advice on that. But what we're seeing is that the bonus depreciation has been falling off in 2023 and 2024. And so we only had about 80% of the bonus depreciation, down to 60% in 2024. What happened in mid-January of this year is that we're back to 100% bonus depreciation. And so that's back and forth. And that's going to drive more and more people to buying property because they're going to be able to write it off on their taxes. So again, just not political one way or the other. This slide just showing you the impact of bonus depreciation and how that impact will have on real estate moving forward. Housing stats. Let's talk a little bit about housing starts. Here, this is the blue line is basically single family housing starts. And then the green line is multifamily housing starts. And you can see the difference there. You can see that, again, we've been falling. Multifamily has been falling dramatically, and single family is as well. Let's talk about home affordability versus rental rates. This is a chart I brought to you in the past. This just shows you the green line is the cost to rent on a monthly basis. And you can see the red or orange line is showing you the average mortgage cost. So there was a time back in, 2009, 10, 11, 12, where interest rates were really low and it was cheaper to rent than own. That is not the case in the last 3, 4 years. It is a lot cheaper to rent than to own today. And so, again, the mortgage costs are at really all-time high because of interest rates, and you can see the impact there to the consumer. Rents have still increased dramatically, but the cost to rent, the cost to own has increased even more. We've gone from really $1,400, $1,500 a month to almost $2,900 a month. So that's impacting people buying homes, which is why we're seeing less sales. Okay, summary and conclusions. Bellingham, Whatcom County vacancy rates have remained lower than the nationwide average, albeit they're up from where we've been in the last 5, 10, 20 years. New construction is locally has pushed the vacancy rates back to normal levels. And as you can see, we're starting to fall back a little bit. And again, the future here looks pretty strong for the vacancy rate to more normalize in and around the 5% range. Vacancy rates are starting to decline. Higher interest rates have kept homeowners in their homes longer. Housing payments to rent payment gap is high. That's actually good for rentals. That's a positive thing. So again, as interest rates come down, more buying power for people to go buy homes, that might drive some of the tenants out to buying property. So again, there's a double-edged sword on both of those for interest rates. So again, but today, that gap has really never been that high in the last 20 years. Long-term real estate outlook continues to be positive for Bellingham, Whatcom County, and really even the U.S., depending on which specific market you're in. Multifamily sales are flat to slightly increasing. And that is it. Thank you so much for being a part of our quarterly webinar. We are just over by about 5 minutes here. Kim, thank you again. I think you have some announcements. You got a couple things coming up for clients. Did you want to bring that stuff up?
Yeah. I kind of mentioned some of these, but we are working on budgets for all of our large multifamily properties and all of our commercial properties. And then we're scheduling one-on-one meetings with some of those owners as well that are interested to go over the property budgets. We want to have those all done before Thanksgiving. We are working on winterization at all of our multifamily properties as well. well in commercial and getting snow contracts signed and finalized, believe it or not. And then I just wanted to mention that several of our team members are going to be attending the Appfolio conference here next week, which is in San Diego. And we're just really excited. We're really invested in the technology aspects and just learning and educating our staff. So it's a great conference where we can learn a lot more about property management and trends and technology. And things that are coming down the road. And then last but not least, we do plan to have a client appreciation event. Finally, we've been wanting to do that ever since we moved into our new space. So we are going to be doing that event in January. We'll be sending out invites in probably a few months for that, but just kind of a save the date. Excited to have that as well.
Awesome. Thanks for that, Kim. I don't see any questions. If there are any questions, love to answer them, but you can always reach out to either Kim or I. Our emails and our cell phones are right here. Our direct lines are right here. So we want to be available to you, our clients, and we just really appreciate you being a client of Landmark. And yeah, so that's it. So, unless there's any questions, I think we'll go ahead and conclude. So,
And then just a reminder, this is recorded. We will send it out to everybody.
wonderful. That's great. Kim, thanks so much
Yeah.
for all that you're doing. I know you're working hard. I know the team's working hard. And again, on behalf of all the employees here at Landmark, thank you so much for being a part of our quarterly webinar and the information. And we just look to serving you here for the rest of the year.
Yeah.
Take
Great.
care, everyone.
Thanks so much.